I think what will be keeping us busy are going to be the bridge debt that's coming due, and either the lenders or the operators asking us for opinions of value for those deals. Besides bridge debt, it's going to be any kind of a refinance moving forward, because I think that's really where a majority of the distress in the multifamily space is going to be. Because again, we're not seeing it on the metrics of the income side. So it's not like we're seeing major vacancy issues. Mm-hmm. We're still seeing people that are not leaving. So the metrics are still going to be there. But I do think there's going to be some distress start trickling. It's not going to be like office, but it will start trickling. And the thing that happens with that, where we're trying to get some of the owners to accept offers right now, is once that distressed debt hits, those become the new comps when they sell.
Mm-hmm. That's interesting.
So if a deal right next to you sells for $20,000 a unit less than you're trying to get, that's your new comp, unfortunately. And that's where appraisers, that's the low-hanging fruit for appraisers, is to go right next door to a deal that just sold.
Hi, Adam Gower here. I am host of the Real Estate Reality Show on YouTube and on podcasts everywhere, and founder of Gower Crowd. Today's episode is with Reid Bennett, who is National Council Chair of Multifamily Properties at SVN out of Chicago. Now, I met Reid on LinkedIn, where he has been posting some very interesting data and information about multifamily across the country and all the influences impacting that asset class extensively. In today's episode, we are going to talk about loan maturities, how the cost of capital has a huge impact on commercial real estate, specifically on multifamily. What has been the impact of interest rate hikes on multifamily and on cap rates and on values, etc.? What are the regional variances in multifamily real estate fortunes across the country? And we also talk about the implications for investors and sponsors of cash-in refinances for multifamily. It is a fascinating episode today. Reid is extremely knowledgeable. He talks to 60 sponsors every single week. So what you're going to hear today is a consolidation of the intel that Reid gathers on a regular basis of what's going on in the market. He is very, very insightful. Do me a favor. Please go to YouTube. I think it's youtube.com/Gower Crowd and subscribe to the channel there and post a comment if you like what you hear in today's episode. And I will be sure to respond to you over there on YouTube. And of course, if you want to find out more about Reid and SVN and what he's doing, including a link to his LinkedIn profile, just go to gowercrowd.com, look up the podcast page there, and I will include links to Reid and everything that you need to know about him. All right, that's it. Without further ado, let's get into my conversation with Reid Bennett of SVN. Here he is. Reid, thanks so much for joining me on the Real Estate Reality Show. I'm delighted to have you. I've been following you a lot, as I mentioned, on LinkedIn and looking at all your posts. And so let's start with this first question. We were just chatting for a few seconds.
Okay.
You have noticed a large amount of syndicators in the last 5 years. What have you seen? What is it that you've been seeing that speaks to where the market is likely to go over the next few months?
Sure. Yeah. So I've been selling apartment complexes for 21, almost 22 years, solely multifamily. And I have never seen as many syndicators jump into this market in 22 years. And so, what I was mentioning to you before, it was for the guys that remember Carlton Sheets. It seems like that kind of a situation where, it's like a handbook. Here you go. Now you're a syndicator. Just read this book and go syndicate deals. And interesting. I had a syndicator once tell me, if it's a good deal, I buy it for myself. If it's a bad deal, I syndicate it and fee the shit out of it. So,
really?
Yeah.
So what have you seen? So what are so describe the, the nature of the syndicators that you've seen coming into the market, and how have they been looking at deals?
Well, a lot of them were not around during the downturn of 2008. So they've all come in 15, 16, 17, 18, 19, when the trajectory has just gone up and things only get better. And all you have to do is buy a deal, raise rents a little bit, cap rates, if you raise rents a tiny bit, the appreciation is going to catch you and you're going to be able to return your investors. You see these LinkedIn posts, just had a deal, just go full cycle, and we just returned 3.2 times, the investor money, fantastic deal in 2 years.
Right.
So, it seems like a lot of groups were looking at 5 to 10 year deals that were hitting their number in 2021, maybe 2 years into their deal and selling it. And so then they're, sending the next deal out to all their investors saying, look, we'll do it again. And it just, we personally invested, my business partner and I, with some of our clients in the space, and I'm seeing capital calls come in my email box. So it's a changing market for sure.
So, I need to look it up. Capital Sheets. What was that? Is that
Carlton Sheets?
Carlton Sheets. Okay.
Yes. Carlton Sheets was the no money down guy, and he would send you these, there was tapes or CDs on how to buy all of your, investment property, no money down. I don't know why it reminds me of that, but because it just seems like it's something that should be it's like an infomercial at midnight, like, just become a real estate syndicator. You can do it too. Everybody's doing it.
Well, the thing that I remember that, from when I was first in the States in the 1980s was seeing, I wasn't really tuned into it. I was doing some capital raising for a ground up multifamily guy, but it was some fellow who did these infomercials from a hammock or something in Hawaii.
Why not?
Basically, it was the same idea. So
what's easy? Because it's easy.
So exactly, right? How easy it is. So what's going to happen? What do you see is going to happen then? Or what are the dynamics that are changing the market, and why you reference this, right? You've talked about how they've had some big wins, these newcomers to the industry. What is going to be happening over the next few months? What are you seeing in the market today?
Yeah, well, sure. Well, I saw a number of groups become multimillionaires just refinancing to 3% debt. Because a lot of these groups, they bought deals when the debt was, really where it is today. And if a deal made sense that where the debt were at 6.5% debt, when a 3%, or we're selling a deal right now that is a 2.37% fixed loan on a multifamily asset, when you can refinance and pull that kind of equity out, it's fantastic. We've had syndicators I've seen do. They'd get a point when they return 50% of the equity to their investors. And when you're in a declining interest rate market, it's very easy to make that point fee, right? So now what we're seeing, if you have investors, and we're involved in one deal right now where they missed the mark and they did not refinance out of their construction loan. If you're at floating rate debt, or if you have a construction loan, it's going to be at this point a cash in refinance, because there's the debt coverage ratios are now, it's funny because I had heard somebody say that most of the bankers have 7 to 10 year amnesia. They forget what happened 7 to 10 years ago. Right. So now they started dropping the debt service coverage ratios down to like 1.15. I saw one at 1.15. I saw one at 1.1. Which is just insane, right? Because anything goes down, your boiler goes down, you need a new roof, you need a couple new windows. It totally shoots your cash flow. So we saw that happening, and when we started seeing, we provided an offer of a 250 unit deal outside of Chicago in a suburban market at a 2.67 cap, a 1985 vintage deal. and the seller turned it down. So when I started seeing that, and then I started seeing all of the refinances where I just couldn't believe the amount of money that was coming out of these deals. It caused me to pause a little bit. And now, we submitted a number of off-market offers in 2021 and 2022, and we're getting all these owners starting to call us back, say, we're thinking about taking that offer now. And, now it's 20 to 33% below what those values were.
That's humongous. That's multifamily you're talking about.
That's multifamily. So, that I'm not even talking office. I don't deal with anything but multifamily. So you can imagine what that will do on a refinance need right now in this market with
22 to 33% decline in value wipes out investor equity, basically.
Correct.
So what are you seeing with, because actually first, just for that one guy in the audience that doesn't know what a cash-in refi is, what does that mean exactly? And what are the implications for the sponsor and for their investors?
Absolutely. So a cash-in refinance is when you go to the bank and you say, look, I have $1 million in debt right now. I'm cash flowing. Can I just refinance this $1 million and continue moving forward with this loan? And the guy says, well, okay, sure. Let me see your books and records. And we're saying, well, the way we're underwriting your property right now, we'll continue with this loan, but we need you to come to the table with $250,000 of money, and we'll give you that same loan again. And that's where the cash in, everybody knows about what a cash out refinance is, right? Where they pull out the equity, you go for, you have maybe $1.25 million in that deal. And then you go refinance, you take out that $1.25 million, but your value is $1 million. So you take out $250,000 and you put that, it's tax-free, you do whatever you want with that. Now what people are going to find is that the value is dropping. So when the lender comes in and says, sure, we'll now give you 70% of a loan to value in your property and your value has dropped, you have to come in to the deal with that additional amount.
And so what's the implications then for investors? Is this what you're seeing in the capital calls that you're getting? Is that what's triggering it?
Yes. So the investors, either the main principals, the GP either has to come up with the money, or they're going to be calling on the limited partners to with a capital call to bring in money. And that obviously isn't going to make all of your limited partners very happy. Mm-hmm. We're seeing that on deals that were just put in place less than a year ago.
Really?
With capital calls. So,
and what happens if they can't come up with that 30% extra cash?
Well, they first will try to, if the limiteds won't come up with that cash.
Or between them, the GPs and the LPs together, they either can't or won't come out with the cash.
Well, this is where the distressed assets come. So this is where a lot of the lenders are going to be saying, okay, well, we're going to take back the property at this point. Depending on whether you had a recourse or non-recourse loan, either you're just handing them the keys or you're responsible for that personally. And I think we're going to be seeing a lot of that coming in the second quarter of this year and early part of 2024. Although the main difference that we see in this market as opposed to the 2008, 9, 10 era was there's still a ton of capital chasing these deals. And the multifamily metrics have remained very strong because in this recession that we're in or heading in, we still have fantastic employment numbers. So the tenants are able to still pay rent. The other thing we're seeing is home prices still have not come down. So home prices are still sky high. And now the tenants that would be homeowners are not able to get a loan. They can't afford the property. And so they're going to remain in the rental houses and in apartments. So the metrics are going to be remain strong moving forward, which is a little different than we saw in the last cycle.
Yeah, and that's an interesting point. I saw a chart that showed the divergence between what it costs to buy a home. It's also on LinkedIn. What it costs to buy
I think
a home.
I posted that for you.
It might have been. Thank you so much. It probably was. It was a really good chart, actually. As I scanned through fast my feed, I saw it. But it's the difference between the amount it costs per month to buy versus rent. And it's at an all-time high. In other words, housing is at an all-time high relative to rentals.
Correct.
And with a strong economy and full employment, does that mean that we're going to continue to see rental rates climbing at these astronomical rates that we've seen over the last few years?
We are not going to see the rental rates climbing. I mean, the thing that we saw over the past 3 or 4 or 5 years has been double-digit percentage increases, even in secondary and tertiary markets. Mm-hmm. The challenge we're starting to see in the market, especially in secondary and tertiary markets, is those tenants are tapped, right? And they've also been affected by all the inflationary pressures on the rest of their expenses, the cost of food, gas, clothing, all of that has gone up tremendously. They've already been hit with 2 or 3 double-digit rental increases. And so now we're getting to the point where it's kind of stretching. A lot of these tenants are spending 40 or 50% or more of their income on rent, which historically speaking, you want to make sure your tenants are only spending about 25, maybe 30% of their income on rent. Mm-hmm. And now we're seeing really distressed metrics there as far as 50% or higher is going to rent.
So what's that going to do? So one of my questions was, haven't rents gone up? You talked about, we're looking at debt costs going up dramatically, cap rates going up, so declines in values. But sure. I kind of know the answer to this, but what is the impact of increasing rents had on that? Haven't rent increases compensated for those dynamics?
No, they haven't. Because if you look at it, and what we're doing right now for a lot of our multifamily clients is called an inflationary audit. So what we'll do is we'll take each line item of the expenses and we'll show you exactly where each line item increases. And you can have, historically speaking, we've seen maybe 3 to 5% increases in rents has been like a decent amount of rental increases. We've seen 10 to 15% increases on the rent side, but we've also seen the expenses increase 25 to 30%. So it's not quite catching up. And then if you're in an area, a municipality that has a big tax burden that they're placing on you, like here in Chicago, that's all they do is they continue to just add another tax. The new mayor is just now threatening a new transfer tax for real estate transactions over $1 million. So, you can't keep up with, and that's the other thing, that a lot of the politicians that are talking about rent control and just throw another tax on the multifamily operator, they don't realize that what that does is the landlords have to throw that off on their tenants. And so in essence, what these politicians are doing is just raising the rent on all of their constituents in the market. Yeah. So the expenses are going to be far outpacing the rental gains that we're going to be able to see moving forward right now, I believe. But
even rental rates, they're not going to be sustaining the same kind of growth that we've seen over the last year.
No. And that's where a lot of the syndicators over the last few years, they saw a huge increase to their numbers, right? So if they saw a deal where they were $150 to $200 below market, you go in, if you have a 100 unit deal, multiply that by $200 increases times 12, and then cap that out at a 6 cap or a 5 cap. You just added millions of dollars of value to that property. That was easy to do. I think that's going to be a little more difficult to do moving forward.
Which dovetails exactly into my next question: is what are the biggest mistakes you've seen? I'm not sure what would be the term. I'm using the term novice or newcomer sponsors to the industry. This raft of education website, sponsors. I keep forgetting his name. Carlton Sheets.
That's the no money down guy. You can buy anything, no money down, right?
So what are the biggest mistakes you've seen these sponsors making, and are they still making them?
Some of the biggest mistakes I saw them make are just having very aggressive assumptions on both the increase of the income and their ability to decrease expenses. And especially, we saw, I would say 67 to 70% of the deals over the last 2 years have been by groups that have come across state lines. So you're not talking about, owners and operators and syndicators that are buying deals in their backyard when they understand the nuances that are going on in that market. A lot of people, like if you're going down into the Carolinas, you have to understand about polybutyl piping in that market, or else you're going to get, crushed by deals that you don't understand or didn't know to look for. If you're in other certain municipalities where, different water bills and sewer bills are split up differently. You have to understand the various nuances, and that's why you need a specialist on the ground that's helping you navigate those certain nuances in that market. Yeah, and also tax assumptions can be significant as well, can't they? How especially does that here in Illinois? I mean, because we have groups. I mean, you're in California, so it's very easy in California, right? You know exactly what your taxes are going to be based on the purchase price, right? Here in Illinois and in many other Midwest areas, you have no clue, and so you can talk to 3 different real estate tax attorneys, and they're going to give you 3 different assumptions. They're all going to be worst case scenarios that you're going to have to work backwards from. But that is a big challenge. Some areas around the country, they chase sales and they chase the price. Others don't, or they say they don't, even though they do. But then, and then a lot of groups or a lot of areas will just change the millage rate. So you never really have a great understanding, especially here in the Midwest, of what your taxes are going to be. Right. And I hear that in Texas, there's no income tax, but you do pay tax on properties. That goes up, and it's not insignificant. So if the value of your property goes sky high, you better well have written that assumption into your underwriting at the beginning. Absolutely. What about cap rate assumptions? Because that obviously drives forward-looking cap rate assumptions. Sure. What have you seen in terms of underwriting? I mean, you've obviously seen a lot of deals that people have bought that you've not been able to figure out how the heck did that, how did they make that work? So what about cap rate assumptions? Because that's a major driver as well. Yeah, it was really interesting. So here at SVN, I run it was a monthly multifamily call for all of the advisors across the country. And we were setting records in cap rates and rental rates from 2015 all the way to 2020. Every month, it was like a broken record on that. So, cap rates were compressing and rental rates were going up. So right now, what we're seeing is a significant expansion in those cap rates because, we hit a point where it was negative leverage, where the cap rate was higher than the cap rate was lower than the interest rate. That obviously can't work. It's not sustainable. And the only time it was actually working was if it was a major value add where they were buying it at maybe a 5 cap, but they knew they could get it, once they put all of their improvements in the property was going to be a 10 cap. So that's the only reason that some of those were working. And then it totally flipped over. And now we're seeing a pretty considerable expansion in the cap rates. Is it lockstep in your view with interest rates? So if interest rates, it's not. It never is. It's not a direct correlation to that, but it does have an effect for sure, because your cost of capital will determine what your cash flow is. So your cap rate is only a function of your NOI based on the price. Which is another interesting thing. I did a LinkedIn post about the NOI, and one of the gentlemen that I had sold 2 complexes to and owned and operated over 3,000 units. He said, "Man, I'm glad you posted that about cap rates. All you brokers talk about cap rates, and I never knew what that was." So why? I said, "Dennis, why didn't you just Google it?" He goes, "I don't have time to Google it. I only care about the cash that's in my pocket. I don't care about what you guys talk about with cap rates." So it's funny that you bring that up. But yeah, cap rates are definitely expanding. and there was one piece of information that I've been using for the last year that Yardi Matrix did on a webinar, and that was for every 35 basis points the actual interest rate rises, you have to raise your NOI 4% to equate the same purchase price. And that's difficult to do. I mean, and we've seen it go up 300 basis points, right? So, I mean, you're talking about 20 to 30% increase in your NOI to hit the same price, which is why I'm telling you that's why the prices are dropping, or the value is dropping, that, you know, by that amount over the last. And it's been quick.
It has been quick, hasn't it? Yes. But has the impact of interest rates flushed its way through yet, or is there still lag in the system that you're expecting to see flush out over the next few months? And if so, over what period of time going forwards? Well,
I mean, it's already made a big impact. Deal volume is down about 77% right now. And that's just because a lot of the people, and we were just out at NMHC at the beginning of the year in Las Vegas, and everybody seemed to be a little bit on their heels because they're waiting to see when the Fed was going to stop all these interest rate hikes, and it's just continued, right? So, you know, what a lot of people are looking for in this market is deals that have assumable financing, long-term, assumable debt, sellers that have enough equity in their property that they can provide seller carry. And then, unfortunately, the third deal people are looking and waiting for distressed assets coming to market, which we haven't seen a lot in multifamily. But
you expect to see that?
I expect there will be distress. It's going to be a tiny sliver compared to what we're seeing in the office market right now, just because the metrics remain high and occupancies remain high, and they will. I mean, some of the offices I know downtown here in Chicago are running at, you know, 20, 30, 40, 50% vacancy. So that distress is a lot different than what we're going to see in multifamily.
And as far as multifamily, then, as far as distress in multifamily, what kind of size, scale do you anticipate? And I'm kind of going back to your comment about, you know, the Carlton Sheets, no money down newcomers to the industry. What kind of, you know, scale were they playing? Is this where you'll see the distress you anticipate? And what kind of size will it be, do you think?
Well, we saw, you know, the syndicators from any kind of deal from 50 units up to 450 units. So it's not going to be small. The deal sizes aren't going to be small. It's just going to be a function of what the lender's position is when they, you know, create the special assets division. That's what we saw in 2008, 9, and 10 is special assets, where all of the mortgage originators at the banks and the different lending institutions, when deal volume slowed like it has now to a screeching halt, they all became special assets. And so everybody and their, you know, grandmother was trying to get a hold of all these special assets groups to get their list and see where have they written these loans down. Yeah. And, you know, can we buy the note? Can we get involved before, you know, because the banks don't want to take deals back. They don't want to get in the chain of title. I remember a deal here in Chicago that the tenants all found out, I think it was in the paper, that the lender had taken back a property in Chicago. And it was we call them California style. You might not, you know, here in Chicago, where you walk in from the outside like a motel. And it had a railing going up, and I think it was only a 25-unit building, and the railing collapsed. And there were 25 tenants that were all laying on the railing when the police showed up, because, like, holding their necks, because they knew the bank took it back, and they knew that, you know, lawsuits could come about. So that the banks do not want to get in a chain of title. They're going to be, you know, writing these deals down and trying to sell them. But at this point, where a lot of the debt is sitting on these deals, there are investors out there that will take that debt over at par right now.
Yeah. And we're seeing those deals actually starting to come to market. You know, I'm not sure how much you know about me, but I was actually brought into a major bank in 2007.
Okay.
I sold out my portfolio and they wanted me to come in. So I was actually on the debt side.
Okay.
And the first round of communication to try and get rid of these notes, that we had with investors was met with disbelief. We don't believe you.
Yeah.
I didn't believe we were
Yeah.
actually doing it because nobody was. But what do you think is going to happen with banks? I mean, what are you seeing? It's a different market today, isn't it, than it was in '07? Obviously, you have deep experience of that downturn. How is it different today, if at all?
You know, what we're seeing with the banks that are failing, you know, three of the major ones, it seems like they were highly leveraged in certain areas, and they were banking on, well, no pun intended. They were banking on, you know, the investments that they were making outside with their deposits to just grow at a larger level than what they saw, and then when all of a sudden, you know, now you can get you know, they're offering CDs at, you know, close to 5%.
Right.
You know, this hurt a lot of those banks. You know, I don't see major bank failures, you know, coming down the pike, you know, especially with the local banks, you know, in our market here.
But what about banks divesting of non-performing or underperforming assets, NPL notes, or
Sure,
if they don't take back loans? I'm sorry, if they don't take back assets in foreclosures. What are you seeing anything at the moment, Reid?
not in the multifamily space as much. I mean, the groups that have a heavy office portfolio, I think, are going to feel the pain mostly at this point.
And what about ground up multifamily? Do you guys deal with ground up versus value add?
Majority of our stuff is value add, even on the affordable side.
And you talked about, in one of your posts, you talked about locations and different locations being weaker than others. Talk to me a bit about that. What areas should we be looking at where you think there will be opportunistic acquisitions over the coming months?
Sure. I mean, everybody in real estate talks about location, and I've always thought that was not correct, because you could have the best location in the world, but you should look at LTC, which is location, timing, and capital. You could have the best location in the world in the worst timing, and it doesn't matter what your location is, or you could have the best location and not enough capital to go into it. So forget the location and focus on the location, timing, and capital. But what we tend to see in the downturns is the areas, the secondary and tertiary areas where groups went to chase yield, is what we called it, right? So they're getting out of the major metros, chasing yield into a secondary and tertiary market, and making, you know, very aggressive assumptions in those markets. On the downturn, those are the first. It makes the wave back into the primary markets. Yep. You know, so you'll get, you know, here in Chicago, it'll be areas like the south side of Chicago or the west side of Chicago where all of a sudden it became very hot towards the end of a cycle. Mm-hmm. Those are the areas that tend to have the most distress immediately when it's a more management intensive property. Or a more management intensive location, or if you have an industry like in a secondary or tertiary market move. We have a lot of businesses moving out of Chicago and into areas like Texas and Florida. If you're in a tertiary market and a major business moves, you have a big problem with that. And we dealt with a couple deals in areas where the industry moves out, like in the fracking areas of North Dakota, South Dakota. Once all those workers move out, it doesn't matter how beautiful of an asset you've built for those people to come in to develop the pipelines. There are no more jobs. It doesn't matter. So, you know, those locations are dead in a certain circumstance. So that's why you have to go back to major metros with drivers, major employment drivers. Those will always succeed no matter what kind of market.
Now, you've talked about the market being down 77%. So what are you doing with the remaining, 30, what are you doing with that 77% of your time? What's keeping you busy, and how are you staying engaged in a market like this? Sure.
Well, you know, it's interesting.
Other than making a lot of extremely interesting posts.
Well, you know, the thing is, I have more time to do that kind of stuff and share. Like right now, it's about sharing information. You know, everybody. So I share information with multifamily owners and operators because they want to know what's going on. What What can I do? And now is when I'm telling all of the owners, because what we call, I try to talk to at least 50 to 60 owners a week. And when I hear, one of these owners that doesn't need to sell, they're cash flowing, they say, I'm not selling right now. I'm saying, good, you shouldn't be selling, but let me, now is the time I have time to meet with you. And let's make sure that you are positioned well to weather any kind of downturn right now. And on the backside of this, when it heats up, and it always will, it's cyclical, as you know, you've been in it since '82. It's cyclical. It'll come back, and it'll be a hot market, and everybody will wish they bought deals in 2023 and 2024 and 2025. They're going to wish that they bought these deals. So what we're doing is just helping owners and operators maximize their current income and expenses, helping them figure out what to do, what they can implement right now to get the best value. Because what I tell all the owners and operators is, you're the ones that have the guts and are taking the risk to buy these deals. And this is why, this market is showing everybody why it's risky. Everybody in good times thinks, oh, these multifamily owners, they're multimillionaires, and we should, that's where all the politicians come in and say, let's start taxing them. But this is the time that if they can weather these storms, they'll be rewarded for it in the back end. So besides doing content on LinkedIn, helping the owners right now.
Well, no, so I'm so glad that you are, actually.
Yeah.
So how are you finding deals that people wish they could buy today?
So in every market, there are deals. There are, and there are only two reasons people sell, right? And it's either they have a problem, or a pain point, or there's an opportunity. So those are the only two reasons people sell. And every single thing that you can fit in there, it fits into those two buckets. So right now, the problem is going to be leverage. The problem is going to be mortgages. The problem is going to be expenses, and a whole host of other problems. Maybe the owner gets an illness. Maybe they go through a divorce. Maybe they have a partnership issue. Those are all problems as to why they want to sell, and they're going to sell no matter what kind of market we're in. Those types of problems are going to be sold. The opportunities are, I want to go into a different asset class. I want to trade into a 1031 exchange, into a couple triple nets and kick back. Those opportunities are going to be a little different in this market as well. But those are the only two reasons. And so we're qualifying everybody right now. If somebody is just looking, let me just see, how big of a price you can get me. We're not working with those people. We're understanding what the need is of the owner. And then we're seeing if that need can be met based on their current situation. So if they're over leveraged and they have to sell at the price that they're over leveraged, it's, we're not the ones that take that on. Somebody else, and brokers are always promising numbers. And we've been passing on more listing opportunities recently than I think we've ever passed on, just because we're not meeting the owner's expectations. When
that's interesting, and it's incredibly high integrity that you say that. But from a broker's perspective, I'm also a licensed broker, though I don't actually use my license these days. But isn't there a value in establishing a relationship with somebody, even if it is at an unrealistic level, so that you can help them? And once you've tied it up as a on a contract basis, that you can help them to understand why it's not going to sell at that level, and then nurture them towards the realistic price?
Oh, absolutely. So, what we like to do with those individuals is provide data, and as much data as possible. Here's what has recently sold. Here's what's currently on the market. Why? So, why would somebody come into the market and pay $1 million more for your property when there's an exact same deal in the market that's been sitting for 70 days? So you help me figure, so that's how we have that discussion. And I just love to provide as much information, like I'm doing on LinkedIn, as much information as possible so you can make that decision. And then if you're still telling me, well, no, I need this price. Okay, well, help me understand. Maybe I'm not seeing something. Maybe there's a value in this property that I'm not seeing that a new buyer would be able to realize quickly, which is why you need this higher price. So that's where we have this, this discussion with the owner. And if it's still, well, I just want that price, we're just moving on. And again, we're only dealing with opportunities that have fantastic debt, in place debt that can be assumed, or there is a story as to, because there are lenders out there that are lending. We're talking to them right now. We feel like there's a lot of activity. We just got a number of deals under contract last week, and all of a sudden it all came in a flurry. So there is activity out there. There are lenders that are willing to lend. It's just you need to have a better story for the deal.
So for these deals, it's interesting you talk about these. You mentioned I think you said 2.7 something debt deal that you just put together, an assumable loan.
Sure, 2.37%.
2.37, extraordinarily low.
Beautiful.
When you sell that, how is that being underwritten, and doesn't it distort the real market by creating a comparable that is not necessarily realistic against other true values in the market? Well,
the loan was played on this particular property as an example. They put this loan on the property in 2020, at the end of 2020. So that's what we're telling people. If you want 2020 and 2021 prices, you have to offer 2021 debt, right? So if you're able to sell
wait, you mean you have to offer 2021 prices is what you mean, right?
If you,
I see. If you want the
2021 price, you have to offer 2021 terms.
Got it.
Which, that's the other thing right now. When we're doing a broker price opinion of a deal, it's almost useless to put in last year's comparable sales.
Right.
Unless you can get that debt today on an assumption.
But isn't that still a distortion, Reid? That's the point I'm making.
Absolutely. But that's what you're looking for right now are the deals that can be done. And those are the real. Okay. So
I see.
The only deals that can get done are distorted, right? Those are the only deals that can get done at this point.
That's interesting. Now, how does a buyer stand out and compete for these undervalued assets? If something does come to market, you got a realistic seller. What makes a buyer stand out?
Well, it's going to be very short to no due diligence, right? It's, the last 3 years, it's been hard earnest money day one. I haven't seen many people offering hard earnest money day one right now, just because, values were, continuing to go up. But that, the hard earnest money up front without any inspections obviously will make people stand out because they know they have a deal.
Or a super short inspection period, right?
Correct. Very short inspection period.
What does that mean, very short? What are you talking about exactly?
Well, I mean, historically speaking, I would say like the average due diligence that we see in the contracts that come across our desk are 30 days.
Right.
If you're under 30 days, I mean, we just submitted an offer last week where it was a 7-day due diligence.
Right.
So then you're sitting there as a seller, you're saying, okay, I'll let this buyer do his due diligence for 7 days. We've also seen deals come in with 60-day due diligence. I'm not taking a property off the market for 60 days of a free look,
right?
For this buyer to go through and do whatever they want to do, and you're missing, especially in a market that is kind of, somewhat going down. You don't want to be off the market for 2 months right now.
And are you seeing buyers gearing up to super fast due diligences on deals in anticipation of opportunistic acquisitions?
I mean, when you say gearing up, are they, am I hearing that in the conversations that they're ready to go on deals like that?
Yeah. Like, are you expecting to see that kind of velocity over the next few months?
I would say for discounted deals, for discounted notes, yes, they have to be. It's the only way those are going to get done when we see discounts hit, but we haven't seen discounts at this point.
Okay, so let's wrap up with this. I've got one final question before my final question. What do you think is going to happen? So you actually said second quarter 23. I think you meant second half.
Yeah,
23.
second half.
We're
You're
almost
right.
at
Right.
June, second half 23. What are your predictions as far as distress, opportunistic acquisitions? We are now on the cusp of June, so we're almost at
Crazy.
Q3 23. Where do you think? What do you think is going to be keeping you busy in the next 6 to 12 months?
I think what will be keeping us busy are going to be the bridge debt that's coming due, and either the lenders or the operators asking us for opinions of value for those deals. Besides bridge debt, it's going to be any kind of a refinance moving forward, because I think that's really where a majority of the distress in the multifamily space is going to be. Because again, we're not seeing it on the metrics of the income side. So it's not like we're seeing major vacancy issues.
Mm-hmm.
We're still seeing people that are not leaving. So the metrics are still going to be there. But I do think there's going to be some distress start trickling. It's not going to be like office, but it will start trickling. And the thing that happens with that, where we're trying to get some of the owners to accept offers right now, is once that distressed debt hits, those become the new comps when they sell.
Mm-hmm. That's interesting.
So if a deal right next to you sells for $20,000 a unit less than you're trying to get, that's your new comp, unfortunately. And that's where appraisers, that's the low-hanging fruit for appraisers, is to go right next door to a deal that just sold.
Yeah, that's a really interesting angle. Reid, I'm trying to keep these down to 30 minutes, as I mentioned. The national commute average compared to the...
That's right. No, we have a lot to talk about right now, though.
There is. It's really, really interesting. And I do recommend anybody at all, if you're not following Reid on LinkedIn, you absolutely should. I'll put a link in the on the show notes page to your LinkedIn profile. Let me ask you one final question. What resources do you use that are available to mortals who are not necessarily in the market all the time, to keep an eye on what's going on in the market, and to just kind of stay up with what's going on a daily basis in the multifamily space?
Oh, there's a number of them. I pay attention to Globe Street daily. I pay attention to Yardi Matrix puts out some great multifamily information that's free. Real Page. There's a couple. Ted Parsons is a great guy to follow from Real Page. He puts out more content than anybody would ever want to.
Is it Ted or Ray? I think you mean Ray. Is it Ray? I gotta check it, because I've been emailing him for the last week asking him to get on.
I'm Jay. Why do I say Ted?
Jay?
It's
That's
Jay.
right. Jay. That's
Jay
right.
Parsons. And actually, I had the opportunity to meet with him. He invited me to an event that they hosted out at NMHC in Las Vegas.
Mm-hmm.
Jay Parsons and his team, they put out some fantastic information on a daily basis in the multifamily space. So I would definitely watch them. CRE Daily is another great, daily update as to what's going on. And that's across all asset classes. I'd pay attention to that. And just from there, I could go on with the lists. Wall Street Journal does a fantastic job as well
of coverage. They do, actually, yes,
with their daily updates. And but the thing is, what you have to do if you're dealing, especially in the brokerage end, we have to take all of this information and digest it and share it with the people that share it with our clients as to, why do I care? Why should I care about this, rather than here's the rates that are here's the amount of money coming due. Why does this affect me? And then when you share that with people, I think that's where it resonates a little bit more.
It's funny you should say. I just had a conversation with a close friend of mine this morning. Deep philosophical question for a few minutes. And he said, it is really interesting. He said, but like my father said, how do I make a nickel out? But he says, right. Why that you have to answer that question.
Exactly. Absolutely.
Like, what is in it for me? That's the answer. That's the question you must always answer.
Exactly.
Reid Bennett, National Council Chair of Multifamily, properties, not for Sperry Van Ness. I've got to tell you, like the Kentucky Fried Chicken, I'm going to just put it on the record. Brokerage, SVN, thank you so very much for joining me today.
Absolutely, Adam. Thanks for having me on.
That was Reid Bennett of SVN out of Chicago. His focus, as you obviously heard, is multifamily real estate. And I do hope that you gained as much value out of my conversation with Reid as I did. Very interesting fellow. And I do think that his sources are well worth pursuing. I will include, I'm actually going to build a list of all of my guests' best recommended sources for information. Of course, you can also subscribe to the Gower Crowd newsletter at gowercrowd.com. We distribute a weekly update of important links and information about not just multifamily, but about what's going on in commercial real estate syndication nationwide. It's completely free, all there at gowercrowd.com. And as I did ask in the introduction, if you get a chance, do go over to youtube.com/gowercrowd. Check out the videos there, subscribe to the channel, also free. And if you have the inclination and you do find value or something of interest in these conversations, particularly with Reid today, go ahead and post a comment. Of course, if you do see us on LinkedIn, post a comment there. It would be good to engage in a dialogue with you on any one of these channels. All right, thank you so much. Reid, thank you. I should start with you. Thanks so much for joining me today. It was an enormous pleasure meeting you IRL. I'm not sure if Zoom call counts as that, but anyway, nice to meet you instead of on social media, on LinkedIn. Nice to meet you on a Zoom line. Thank you for your insights. And thank you to also dear viewers for joining us today. I hope you gained as much value out of my conversation today with Reid as I did. Stay tuned. We will be out with another episode very, very soon. But for now, this is Adam Gower signing off.